What are margin interest rates? Have you ever wondered how investors can buy more securities than they actually have cash for? The answer often lies in margin investing, and a key component of that is margin interest rates. So, what exactly are margin interest rates? These are the charges that investors incur when they borrow money from a brokerage or financial institution to purchase investments. This borrowing happens through a margin account, which allows investors to use their existing funds to increase their buying power in the market. When you take out a margin loan, you are essentially using borrowed funds to invest. The margin interest rates representing the cost of that borrowing. These rates can vary and are influenced by several factors. One important factor is the size of the loan. Typically, larger loan amounts come with lower interest rates. This means that if you borrow more, you might pay a smaller percentage in interest. Another factor is the base or broker call rate. This is the underlying cost of funds for the brokerage or financial institution. It reflects the interest rates that banks charge each other, which can fluctuate based on broader market conditions and monetary policy. Market demand also plays a role in determining margin interest rates. If more investors are seeking margin loans, financial institutions may raise their rates to manage risk and ensure profitability. Additionally, changes in central bank policies, such as adjustments to the federal funds rate, can directly impact these rates. When general interest rates rise, margin rates usually follow suit. Account characteristics can also affect the rates you receive. Some institutions offer discounts on margin rates for clients who maintain higher account balances or larger margin loans. This can incentivize investors to engage in more trading activity. Understanding margin interest rates is essential for anyone considering margin investing. These rates can significantly impact the cost of borrowing to invest. If you are not careful, the interest expenses can eat into your overall returns. For banks and credit unions, margin interest represents a source of revenue, but it also comes with risks, as the loans are secured by volatile investment assets. In summary, margin interest rates are the variable interest charges applied to borrowed funds in a margin account. They are influenced by factors like loan size, base lending rates, market conditions, and client account specifics. Knowing how these rates work can help you make informed decisions about your investment strategies.